Good afternoon, rock stars. Hope you're having a wonderful day. I'm excited. Hope you're excited because it's time for your market update. All right, so we're just gonna jump right in. To understand this market, this crazy market, Fed just raised moments ago the Fed rate again, a 75 basis point rate hike. To understand this market, we have to understand one thing. What is inflation? So, I took down some keynotes on essentially just some good descriptions on inflation because I think it'll be good to kind of hear some other aspects of it other than the fact that, the value of money goes down and prices go up. So there's a little bit more to it. So I want to make sure I got some more detailed explanations about it. Again, just to help us better understand a little bit more. So of course, decline in purchasing power of money while prices increase, rate at which the value of currency is falling, prices are increasing. Inflation measures the overall impact of price changes for a diversified set of products, not just like mortgages or gas, allowing for a single value representation of the increase in the price level of goods and services in an economy over a period of time. Okay? So essentially, break it down. Currency value losing, so currency losing value equals buying decreases, so people buying stuff decreases, which equals the deceleration in economic growth. Okay, so the consensus is that this occurs when money supply growth outpaces economic growth, and the resolution is the country's monetary authority manages the supply of money and credit to keep inflation within permissible limits to keep the economy running smoothly. Okay, so there's many ways to measure inflation. There's many ways to correct inflation, but we're just going to look at what are the causes. What are the causes of inflation? These are going to be probably no surprise. Number one, printing and giving away money. Does that sound familiar? Legally devaluing the currency and loaning new money into existence as reserve credits through the banking system by purchasing bonds from banks on the secondary market. If that doesn't sound familiar, I'll give you some insight into that. The essential goal to control inflation is simple: moderate long-term interest rate, price stability, and maximum employment. Rates to stabilize price, and employment to justify the dollar given. Okay? So let's first touch on printing and giving away money. COVID. Today, we are printing more dollars than we ever have. Historically, it's ludicrous. The amount of money we are printing is just devaluing our currency daily. Giving away money from COVID if you got your stimulus check, it's the government just giving money. Where are they getting that money from? When we already have debt, that's not good. Now, the legally devaluing the currency, there's speculation around that. So that's a whole nother ballgame. So we're not even going to get into that. But loaning new money into existence as reserve credits through the banking system by purchasing bonds from banks on the secondary market. So loaning new money. We're just going to touch on loaning new money. So if you were to look at the stock exchange and you look at some of the major players, some of the major companies. So they're called zombie companies. In other words, they don't help or benefit our economy whatsoever. Okay? They're zero profit companies, but they have jobs. Okay, so they're there for jobs, nothing more. So I'll give you an example. Let's say we're going to use GM we'll just use a hypothetical company. So we'll say company A. So John owns company A, and company A, John has a great idea, says I'm going to create company A, and he goes and creates company A. Company A works, starts to become successful. Company A with one shop, and now it's 20 shops in a local county, okay? And now he's providing all these jobs to this region or this county, and he's like the number one guy, okay? 20 years later, Now, yes, he has all these jobs and things are starting to fade. The business model no longer works, starting to not really progress. But the local government says, well, we need to keep these jobs. So we're going to loan you money at 0%. So John gets the money at 0%, keeps the jobs, keeps the business afloat. Every year, John comes back, asks for more money. Okay, they keep giving him money. Great. Over time, there's a point when they have to fail. So typically what happens is, so when a Democrat comes into office, not getting political here, just kind of the general rule of thumb, they want to protect and preserve those jobs. And in doing so, they want to keep that company afloat and not let it fail. Now, if it fails on its own, it happens, is what it is, okay? But a Republican typically will say, hey, we're just going to let you fail. We're not going to continue loaning money. So John, every Democrat, so every time a Democrat is in office, hey, give me money. Certainly, if there is a Republican in office, there may be a certain contract that the government's already signed, so they're still giving money. John keeps getting money for so long, eventually, the government's not going to have the money to loan to John at 0% interest any longer. Okay, so that is going to be something that is going to happen, where some of these major companies on the stock exchange are going to fail. Whether it's now, whether it's in 20 years, who knows? But there is a point when you can't keep lending money at 0% and giving more every single time year over year. So that's just a major issue that's happening, and that is going to be one of the key players in the future. So something to keep in mind on what's going on in our economy. Now, recent events, trends, reports. So based on this information, obviously we already talked about, we touched on COVID, giving out free money. Clear as day, free money, that's not good. So that's going to hurt. So that's going to cause inflation to happen. War. So we are giving money overseas, and we're also cutting off some other supplies that we have that we need, such as oil from Russia. So now that supply is now cut off, the demand for the price has to increase, because now we're not getting as much. So the supply has significantly decreased. Okay, so prices go up. War. What else about war? Well, if we're giving all our money elsewhere, and we just got through COVID, which we're already trying to recoup money, well, now we're double trying to recoup money while trying to give money, and we're in debt. It's not good. It's not good. So you kind of see where I'm going through here. What does the economy look like? What is our economy surrounded by? Our number one resource, real estate. So housing boom. COVID, housing boom. Pre-COVID, there was an expected 10-year boom. We're still in that 10-year boom. Things have not slowed down. Things have not stopped. I want to make that clear. It's just people no longer qualify that still want to buy homes, that once the rates go down, they will re-qualify and buy homes or try to buy homes. Okay? Very, very big difference than, oh, we've halted things and now prices are going to go down. No. Nope. They're just trying to get some stability in the economy right now by raising the interest rates. But eventually, these people are to come and say, we want to buy, because we don't want to pay $2,200 a month in rent. I'd rather pay $2,200 a month and own a home. And with all the down payment assistance programs and things available now, why not take advantage of that? Consumer confidence and spending. Consumer confidence and spending in 2008 was one of the highest that it's ever been historically. People were just happy spending money. There was also bad loans though. So that was an issue. Okay, there's no more bad loans being done. I assure you, not a single mortgage loan, at least mortgage, is bad. No one's lending bad money. No one. Okay, now some people may make a mistake, but they're not lending bad money. Okay, these are good, sound loans. It's not happening. Okay, so if you're expecting a mortgage crash or something like that, get that out of your head. Not happening. Okay, they are going to do whatever they can to keep real estate and it's all of its industry, like all of the like mortgage, if you're a realtor, all the jobs you're secure. Okay, I want to make that very, very clear. Okay, so consumer confidence, 2008 I'll say it was up here, where it was down here before. It was like, whoop. And then it went down again. It was like, all right, cool. We got things. We get it. This is bad. 2021, it was like 4 or 5x. Quadruple, 5x, whatever it may be. It is through the roof. Interest rates start to go up, and gas prices start to go up, and inflation flipped a switch, and now consumer confidence is dropping significantly, rapidly, and what's also going up is debt. What's also there, home equity, cash out refinancing is the number one thing people should be doing today. Whole nother ballgame. And then again, consumer debt was the last point, which consumer debt tied in with confidence and spending. And again, it's all-time highs. So with consumer debt consistently going up, wow, we're in a pretty rough spot. But as you can see, a lot of this makes sense. Now that we know what inflation is, this is like, this is exactly where we're supposed to be at this point in time with what just happened. Okay, whatever happens in the world, in our economy, like that stuff affects everything all the time in our economy. So we'll go here, key factors. So 100% of the time since 1940s, rates have gone down lower each cycle. Home values have increased. Recession has signaled a rate drop coming soon. Home purchases increase, new products become available, and government and conventional backed mortgages shift, revise, and open up their guidelines to meet the market needs. So just a quick point on each one. Since the 1940s, every rate cycle, I'll do it the other way because we look at it, it's inverse. So for you guys, every time the rates have always gone lower, every single bottom point, it's lower than the previous, okay? 2008 kind of throws charts off, but that's the only time. That's the only cycle since the 1940s that has thrown things off in all these categories. So rates consistently go down. What's going to happen? We can 99% sure, based on prior history, leaving 1% chance that rates are going to go lower than they were. Home values will increase. Home values have also increased since the 1940s, year over year. Again, 100% of the time, they will continue that trajectory. And there's not a single forecaster out there that thinks that, number one, purchases are going to slow down. Number two, that home values are going to stabilize or decrease. They're definitely going to continue to increase over the next 10 years. So buying a home, you could still sell the fact that, hey, you're going to have a ton of equity in the next 5-10 years. So take advantage of buying a home now so you can have that equity. Recession, rate drop coming soon. So every time there's a recession, not at that exact point in time, so not exactly when you start hearing the word recession talked around, but usually within about 6 months or so, that's when you start to see rates stabilize and then they start to go down. So that's kind of the point. Now remember, they have to recoup. So hopefully it's not COVID. You don't want them just shooting and skyrocketing down. That's bad. Because that's what happened in COVID, and guess where we're at now? They skyrocketed up. Whatever comes down goes up, okay? So that's usually history, or the cycles will tend to repeat themselves, okay? So rate drops will happen typically right after you hear recession within about 6 months. So the Fed has a choice. They can say, we can cauterize the wound and just amputate that arm and call it a day, cut off the infection and just hike up the rate and just call it a day. That's what I hope. That's what you should hope. You should hope that they just hit it right there. Because guess what? That means we could stabilize and do things a lot sooner. If they decide to dilly-dally and kind of let it drift on and do their thing, it could be February, it could be March, it could even be May of next year. If not even longer than that. So hopefully they don't drag this thing on and they can hit it sooner than possible so we can get out of this, but it's all dependent on what the Fed does, okay? Again, home purchases increase, so the amount of home purchases, same thing, every time we go through a new cycle, home purchases consistently increased, which is great. This year they have not increased, but they're still, this is like the third, top 3 year So again, still on this increase. It might have panned out, but it's just because rates are high at the moment, and people who did qualify no longer qualify. They will qualify again. Okay, cool. There's that. New products, and I'll just kind of lump in what the mortgage entities, so FHA, VA, USDA, which is under Ginnie, then Fannie and Freddie for conventional, and even just in-house mortgage products that like lenders will roll out. So whenever there's a market shift, a new cycle, things change. There's shifts. Why? Because there's a market need. And with that need, and to help stimulate our economy, the government uses real estate. And so because they use real estate, and that's our number one source of, well, what would it be? So basically that's our number one source for our economy. I can't find the word for it. That is infusing cash. Okay, that's infusing money into our economy. Number one, they will do whatever they can to meet a market need. So they will open up guidelines. They will create new products. They will do all sorts of crazy stuff. I'll get into products here about movement in a minute, but 14 new products alone in the last month. So just the amount of products that you're going to see come out are going to be good, or just guideline changes. There's going to be guideline changes. There's going to be things like that, because that happens every single time. Okay. So there you go. Market understanding. So again, whatever, I should say not what goes, so what goes down must come up. Okay. So like COVID, for example, COVID, we were on our steady turn going down, blah, blah, blah. Rates were going through their natural cycle down, and then tank. Well, that's what happened. They just tanked. What did they do coming up? Kind of mosey along. No, we're going to still stay at these low rates. But psych, no, we're going up. So again, whatever comes down, expect it's the same thing going to happen going up. Now, it's kind of feeling like we're at that point where rates were at the bottom last time. Okay, at the bottom, everyone's like, oh, the rate's going to go lower. What's going to happen? You see another boost, and it's like a little mini, but then it bounces back because it's hitting a threshold. Every time it hits this threshold, it can cross over, but then it pulls right back down. So same thing. So what we're kind of seeing is we're starting to see a lot of resistance at this threshold where rates are, and you'll see it kind of go up, and then so we're getting to this threshold point, which is good. The more you see it bounce at a threshold. Now, if it pushes and pushes and pushes and continues to break, then that just tells you we're going higher. But ideally, when you start to see a lot of resistance, like we are definitely getting to a point where enough resistance can indicate that we're towards the top. And that's what the indication that I have right now is, based on all the data, the forecasters I look into. I will say this: Fed just did their 75 basis point rate hike like an hour ago. Expect more. Okay, there's gonna be some more. And so when I say 75 basis points, okay, that's supposed to mean the cost of a rate. Now, keep in mind, the Fed rates are not mortgage rates. Okay, so here's how mortgage rates are actually set. So I forget who used to do it, but now the Consumer Financial Protection Bureau, CFPB, so they go ahead and they set the APOR, okay, the average prime offer rate. Once they set the average prime offer rate, Fannie and Freddie come in and say, here's our loan level price adjustment. So, if you're a 800 credit score, you don't have a ding. If you're a 780 score, you're gonna get a little ding. 760, a little more ding, so on and so forth. So credit, loan amount, loan to value, all sorts of stuff. So in their electronic system, plug in the APR, all the LLPAs or loan level price adjustments kick in. And then from there, investors say, this is what we will pay for loans. Or if you're a credit union or a mortgage company, we are the one caveat at Movement, who will set our own interest rates, and we are not subservient to investors, then we cut out the middleman and just set our rates. If an investor says, I pay 3%, all the investors pay 3%. It's not like a one or the other, like one guy's paying 3, the other guy's paying 250. Like it doesn't work like that. So investors will dictate rates, and then and then the mortgage company will come on and say, hey, here's the, we're going to come on behind the investor and here's what the rate's going to be. Or just the company, if it's direct and they're not worried about an investor or anything like that, they're just going to set those interest rates. Those companies are always lower, is what it is. So that's how pricing has worked. With inflation, okay, and real estate, yes, the Fed rate isn't the mortgage rate, but indirectly it does affect mortgage rates. So it's kind of like, yes, mortgage rates are not the Fed rate. The mortgage rates didn't hike up, 75 basis points, but you're definitely going to see a hike on the mortgage side in those rates as well because of inflation. Okay, so there's a lot of factors that do go into it. All right. So bear markets are natural, so don't freak out on this. Obviously, it's been crazy, but don't freak out. Bear markets are natural. They don't last as long as bull markets. They never have. Again, other than 2008. That's the only caveat. So you're not going to see a bull market for 3 years and then a bear market for 3 years. You're going to see a bull market for 3 years and a bear market for maybe 1.5. That's usually what happens. A bear market tends to be less. Now, that's just a typical. It's not all the time. Okay, so based on percentages, we'll call it 65% of the time, a bear market is not as long as a bull market. So bear / like bad market, bull, run, good market. You're going to run up. Okay. So essentially, what does that come down to? Sometimes we just need to ride the wave. So we just ride the coaster. Good thing is, there's always people buying homes. You never have to worry. It doesn't matter if rates are in the teens. Someone's always buying a home. They just may put down more cash. So as a loan officer, we have lower loan amounts. But that's not a big deal. They're still buying homes. Refinance companies, refinance central lenders, where refinance is like the biggest part of their business. You see shutdowns of lenders all over. They're already shutting down right now. But that's because their business models for refinances. Okay? So just keep that in mind. It's really not a big deal. There's always people buying and people are still wanting to buy. There's no shortage of buyers. It's just some people now don't qualify that will qualify here in another 6 months to a year, and they're going to be buying a home through you because you're a rock star. All right, projections. So if Fed decides to cauterize the infection, just amputate this right now. I'm kind of thinking September, November, we're going to see some stability and then do the downturn to recoup from where we've come. So probably in about 12 months, you'll see rates, if they did it right now, you'd probably see rates probably back down into 4s and high 3s, somewhere in that ballpark. If they decide to drag it on, again, this could be March, April, May, even further into next year. Delays obviously will be brought from that. So the shift I anticipate, I do anticipate higher sales. So in 2023, I think we're going to have one of the largest, again, another increasing year, just like historically, one of the largest years in purchase sales. With the recession coming up and new products getting released, you're going to see people buying more. But you have to consider the demographics. Okay, just like any business, you have to look over the demographics. Who are you selling to? Who's going to be your number one client? Okay, millennials, diverse people groups. You're going to have Hispanic, Latinos, Black, Asians, tons of other demographics other than white that you're going to be working with because they are buying homes. So you need to adapt. You need to adapt as soon as possible. So higher sales, continue home purchase craziness because everyone's, their mother's brother, sister still wants to buy a home right now. Cash out of home equity. So encourage people to cash out their equity right now. I can't stress enough. If you want, like the amount of equity people have, they can go cash out their equity, whether it's a cash out refinance, a home equity product, which is preferred right now, doing a home equity line of credit, home equity loan, to do that because you're going to pull that cash out and you're now instantly debt free outside of your mortgage. And then you could just sell your home and you're debt free. So you're going to have a mortgage. We accept that. But you could be debt free right now and save a ton of money per month. You could also pull that cash out of your new gifted equity, have the money for a minimum down payment and closing costs on your new home, pay off a portion or all of your debt, and now qualify with 2 homes. You have 2 debt payments, one, the other. Before you close, if you get a lease agreement on the primary home, bam, now you qualify and you just need one mortgage payment because you got a lease agreement on the other. You can cover up to the principal, interest, taxes, insurance, and HOA dues on the current residence. Bam. Just find a rental for 1 year, 1 year contract, get them in there. You have a year to sell, like in 1 year after that, guess what? You're gonna be so thankful because you're gonna sell that property. You're gonna make even more money at that time. Why? Because home values are increasing, they're not decreasing, okay? Renovation boom, renovation, that should be in your arsenal. Renovations are gonna be one of the #1 products here in the next 5 years. Why? So if you have a housing shortage, what can you do? Well, you have some homes that don't sell. What's wrong with them? They've got issues, structure, foundation. It could be just tons of old cosmetic stuff that no one wants to deal with, just pain in the butt. But you do a renovation loan, and guess what? You are creating a new market for yourself. You're going out there and saying, okay, I'm going to renovate this property. We're going to buy this property, go there with a certified contractor, or find a company with a certified contractor and go out there with, the designer and actually, start painting the picture to people as they get out there and say, hey, you could do a renovation on this property. You want the old farmhouse? Guess what? You can do the old farmhouse. You're going to do renovation. And you go buy that property, you do the renovation loan, you just created a sale for yourself that no one else is doing in this market. The renovation loan is a key product. You can do conventional, FHA, VA. USDA might have a product, I'm not sure, but I've never used it. I think they do, I'm not entirely sure. But fantastic product, I love it. I think it's a great loan. You have to, like the old movements to like the #1 renovation company. We have simplified the process. But again, other companies can do it. And if you go out there and you do a renovation loan, just please make sure you review their guidelines. Review like what because there's a lot of companies that limit their renovation guidelines. Not a lot of companies want to do the renovation loan, or they're very strict on like the reserve requirements and certain things that they do require. So great example of renovation, then I'll jump off of it. So in Seattle, okay, it's a big Asian population up there, okay? And they tend to live with family. And so what they do in Seattle, it's a big renovation spot, is we'll say they have this small enough plot of land, but enough to build a carriage house, a second home on the property. You can do a carriage house on a conventional renovation loan that's either half the square footage of the primary residence on there or 1,200 square feet. So you can have a second home on the property. It's not a big second home, but it's still a second home. And they are building those all over Seattle. So just imagine where you're at, finding homes where you could actually build a carriage house on. Or if someone, hey, there's a home, it's not big enough, you could do the renovation loan, like whatever it may be. There's many ways you can use a renovation loan. You can even just put in a pool. So, hopefully that's not why you're doing it, but there you go. So anyways, there's that. So there's renovation. And then as we continue into the projected 10-year boom, as predicted from 2020 to 2030, again, diverse people groups are leading the way. So again, a lot of things to consider here. I will leave you with one last thing on the market. Consumers that are coming up are more educated than anyone's ever encountered. Okay, it's not like, put it this way, the art of sale is gone. It's dead. I don't care what anyone says. It is dead. Do not try to sell someone. People are too smart. There's too much information at your fingertips. Be an advisor. If you are an advisor, you will win in this market because no one else is advising. What they're doing is they're trying to sell against each other. The more you sell against each other, the more you're going to lose. So you really want to focus on honing in on the fact that our consumers are educated. there's too much here, too much evidence. I don't even need data anymore to determine that the people that are going to be buying homes over the next 10 years, that all those first-time home buyers, whoever maybe, are going to be more educated. 20 years ago, you didn't have all this information at your fingertips. People go to buy a home, they're looking everything up that they can. They're on Zillow, they're on Redfin, whatever it may be. But what they're doing is they have so much information, they need someone now, not to sell them on buying something, they already sell themselves. They need someone to come in and help them navigate through all that clutter of information, because half of it probably doesn't even pertain to them, or it's not even relevant. So if that's the case, be the advisor. Know that your market, number one, is diverse. Diverse people groups are going to be the number one home buyer over the next 10 years. It's going to hit that point. And people are more educated, so tune in to their understanding. Go ahead and help navigate through all the education that they have. Acknowledge that they're educated. It's something to definitely look out for. So, last thing I'm gonna leave you with, movement on the horizon. So, like I told you, or I think I mentioned this. So essentially, there's two ways to profit with a loan. I mentioned it with about the rates. So how rates are priced. So there's two ways to make money in the mortgage business. One is you're a lender and you decide to sell your loan up front. So you get a warehouse line. Let's say Chase is giving you a rate of 3.75 on a 30-year mortgage, for example. You're basically saying, okay, Chase, thanks for your warehouse line. I'm going to commit to you on this loan, and we're going to sell you the loan right when we close. Cool. That's one model. You make your profit right there. Pay back who you have to pay back after you make a profit and you sell it. Number two is you retain servicing rights. So you have an investor. When you retain servicing rights, what a lender does is they're going to say, okay, I have to give the investor, so we're going to get a premium check from Fannie, Freddie, FHA, VA, USDA. We're going to get our premium check. I have to give the investor a cut of that. And then after I give them their cut from this loan, then I have to give them a cut as I service this loan over time. So what Movement has just created is a third way. So we have the number one guy at BlackRock, I should say the guy who has the number one portfolio in the country for what are called MSRs, okay? So essentially a servicing portfolio for lenders, okay? And we are creating our own ecosystem. So what we're doing, okay, is we are taking our entire servicing portfolio and we are going to dictate what we do. And we are cutting out the investor from the equation. So what that means is that movement rates are going to be movement rates, not an investor overlay on that rate. So that means movements rates are going to be so much lower than anyone else, it's going to be stupid. Okay? Keep in mind, we give 50% of our profits to nonprofits. So whatever we make on the deal, we get 50%. Okay, so we're going to be so aggressive there. What that also gives, the more important thing, well, I should say the number one important thing is giving back. Giving back is definitely the most important thing. No other company is giving back right now 50% of our entire profit per loan. Holy moly, we are changing lives. That's crazy. But what else are we doing? So that gives us the ability to set our own rates, but also to roll out our own products. We released 14 products in the past month alone, okay? Now, they're all not new products, but we have released 14 products. We are releasing more and more products. There's now new products that are going to be cash offer-based products. There's obviously Lock-in Shop is a great product as well. We're putting in an in-house down payment assistance program. So many of you might know about broker and correspondent if you're a little bit more in depth in knowledge in the mortgage industry. So broker means you're the middleman as the lender. You just gather the docs and you're just spitting it over to the non-QM lender. If you're correspondent, the non-QM lender says, here's the guidelines. You go ahead, you dictate that process. When you're done, you then send it to us for final approval. We'll sign off on it. You can close your loan and then you sell the loan. Cool. There's two. We got one. We got two. And then we have in-house. So in-house means it's like Movement, for example, like Movement or PNC or Chase. They are doing that loan. It's their guidelines, their underwriting, their everything. That's it. You close the loan, you're with them. No one else. So we are coming out with our own in-house down payment assistance program. What else are we doing? We're coming out with our own home equity product. August 1st, home equity product. Look out. This thing is a 5-day close. You're going to be able to tap into equity where other people typically can't with a lender, okay? Lender, not with a bank. You can do it with a bank, but remember, the guidelines are going to be more restrictive. So right now you see credit unions, banks, they've pulled back on some of their guidelines. I just had someone look for a deal with a credit union who I know is pretty aggressive on the rate side, and they required 30% down for them to do a loan. 800 credit score and over $200,000 in the bank. Are you kidding me? And they had to put down 30%. That's how much these banks and credit unions are restricting what they do. So just imagine we're coming out with a home equity product, a product that is not their primary bread and butter. Okay, so they're gonna really, if they're gonna pull back on any product, it's that product first. This one for us is gonna be huge. Again, more and more products that we are rolling out every month. So make sure stay tuned. I'm gonna be releasing products as soon as I hear them, and you'll get them here in the chat. And then the last thing is technology. So we got on the ground floor in technology with a company called Blend, and now we sell that product. Well, not us, that company sells that product, but we have come so far with the product. We are so many versions ahead because we cultivate it. So if we're cultivating our technology, and we are coming out with home ec, like these products that have certain technologies around them for the process. Just imagine where we're going to be technologically. Everyone, because we already can do full electronic closings. There's certain parameters around it that companies like us are working out the kinks on it, but they're done and they're getting done and they're going to be the future. So just think full electronic closings, all the technology that's involved. The more you can get involved with technology and put your company now in a technology-based environment is going to be good for you. It's going to put you in a position where you're thinking forward. If you decide to stick with the old stuff, there's some stuff to remember that, hey, this is where I came from. This stuff old, I get it. It's good. It works. But over time, you still have to adapt. So adapt to technology as soon as you can. So I hope you enjoyed this market update. Again, whoever you work with, still work with them. I want the best for every loan officer out there. I'm just here to give market updates, information. I just know we're on the cutting edge of a lot of things. And so in doing so, I want to make a lot of these things known because we usually come out with things first before other places do. So again, hope you have a wonderful day. Hope you enjoyed it. And that was your first market update.